We've delivered a strong set of first half results underpinned by some excellent operating metrics, which reflects a portfolio that's well positioned to take advantage of our favourable occupational and investment market conditions. Adjusted pre-tax profit was up 23%, which reflects development and acquisition-led growth, as well as our focus on customer and portfolio management, which have delivered strong like-for-like net rental growth. Adjusted earnings per share were up 3.2% to 9.7 pence, incorporating the new shares issued in the March rights issue. EPRA net asset value per share was up 5.4% to 504 pence, and that was driven by a 4.9% increase in the value of the portfolio, driven in turn by development and asset management gains, as well as by yield compression. The balance sheet has been significantly strengthened by our successful £557 million rights issue and a €650 million private placement, which have created tremendous capacity for growth. 3/4 of the rights issue proceeds have already been deployed or allocated to specific investment opportunities, including taking full ownership of the Airport Property Partnership, the portfolio of industrial property at and around London's airports that we acquired in March. As we look ahead, our future earnings prospects are underpinned by our largely de-risked and fully funded development programme, and the interim dividend has increased by 5% to 5.25 pence per share. On leasing and asset management, we've reported a 28% increase in new rent commitments, totalling £27.5 million of new annualised rental income. What's behind this is a generally supportive economic environment, combined with continuing e-commerce growth across the UK and Europe, which requires modern, well-located distribution facilities to be able to meet customers' ever-increasing demands. Demand from retailers and companies involved in retail distribution accounted for around half of our take-up during the period, including Amazon, which occupied 120,000 square metres of space across the UK, Germany and Spain. Manufacturing companies accounted for a further 15% of take-up, but mainly for distribution rather than production per se. Very little space was handed back to us in the first half, which resulted in a continuing low vacancy rate of 5.5%, and a strong uplift in like-for-like net rental income growth at 3.9%. The development programme has continued to grow at some considerable pace. By the 30th of June, we had 40 projects totalling almost 1 million square metres of space under development, representing £231 million of future capital expenditure and £46 million of annualised new rental income when fully leased. These projects are already 68% pre-let and should produce a yield on total development cost of almost 8% when fully occupied. In the UK, we have 90,000 square metres of developments underway, including 2 budget hotels, a Jaguar Land Rover car showroom, a parcel hub for DPD in East London, and 6 speculative developments of urban logistics warehouses in London and the Thames Valley. In continental Europe, we have an enormous 830,000 square metres of space under construction, including new pre-let warehouses for many customers, including Amazon, Lidl, Metro, DPD, Carrefour, Yoox Net-a-Porter, just to name a few. And in addition, we have a bumper crop of other projects at advanced stages of negotiation, which should become active in the coming months, and these could produce another £14 million of rent when fully leased. In terms of the outlook, whilst political and economic uncertainty has increased in the UK, we're encouraged by the continuing leasing momentum across our portfolio. Business confidence in continental Europe has picked up in recent months, and there's no sign of any slowdown in the growth of internet retailing, which is an important driver of demand for modern warehouse space across our markets. With few signs of any meaningful new supply of speculatively developed space and strong investor appetite for good quality warehouse assets, our business is well placed to continue outperforming the wider market.